Hi, everyone. Welcome to Facts versus Feelings, Take 5. Just like everyone expected, Sonu, we've seen some incredibly strong economic data just in the past week. Let's focus on GDP because most listeners probably understand that. That's gross domestic product, how the economy is doing. Tell me just how strong the economy was in the second quarter.
So the economy grew 2.4% in the second quarter. That's after adjusting for inflation or prices, right? The average expectation was 1.8%, but get this, Ryan, but at the beginning of the second quarter, so back in, at the end of March, beginning of April, most economists were expecting 0% growth, right? And a lot of them are expecting a negative quarter. Instead, the economy grew, as I said, after adjusting for inflation, 2.4%. What's interesting is this perspective, if you look back over the past year, right? GDP growth actually accelerated. It was up 2.6% year over year, which is faster than what we saw before the pandemic, right? And between 2017 2019, we had a pretty good economy. And, to think that the economy is actually running faster than that over the past year at a time when the Fed raised rates from 1%, basically 0% to above 5%, that's incredible, right? And what basically happened is the Fed raised rates, what got hit, the most interest rate sensitive sector, which is housing. Housing makes up about 4% of GDP. Residential investment basically fell 16%. Basically, that's, let's call it what it is. It was a housing crash, right? But what countered it was the consumer, right? Services consumption. That was running really strong. Services consumption makes up about 45% of GDP. And then government spending too. I mean, the government passed a lot of, bipartisan bills, right? You had the Bipartisan Infrastructure Act, the CHIPS Act, and then the Inflation Reduction Act, which put a lot of money into manufacturing, construction, and investment. And government spending makes up about 18% of GDP. So together you had services and government spending sort of counteracting what the Fed was doing. And that's basically why, the economy accelerated over the last year, which is, as I said, pretty incredible when you think about it.
Just like everyone expected. Of course, it's a play on words there because all we've been hearing about for the past year plus is this pending recession that every economist was talking about. So great discussion there. The bottom line, consumers remain stronger than expected. Inflation is coming down. We're seeing that real wages are strong, incomes are strong. There's just a lot of positives that are out there. So now let's talk about the Fed very quickly here. The Fed did hike interest rates once again recently, the 11th hike during this cycle. We think the Fed likely is done hiking. Inflation data from housing, different areas of things that the Fed looks at, used cars are really coming back. Keep this very simple. If inflation's coming back down, the Fed does not have to be as aggressive. Again, if the Fed isn't hiking as aggressively, that can be another potential positive. So, the final thing you and I want to talk about, we got about a minute and a half to go on this. Stock market. We're up 5 months in a row, but here we come into August, September. Everyone listening, August, September historically can be a little bit of troublesome. We are still bullish. We still think stocks are going higher, but maybe some seasonal weakness could be there. One comment for me, son, and I'll turn it over to you. When the S&P is up 5 months in a row, like it is currently as of the end of July, the S&P is higher a year later, everyone, 26 out of 28 times. So just think of that with some really strong returns. This blast of strength we've seen this year is not the hallmark of a bear market, not the hallmark of a bear market rally. It's the hallmark probably of a new bull market that could have legs to it. But just be aware, potentially a little break could happen. I mean, Sono, if we saw a little bit of a break, what are some areas you think investors should look at to potentially add to their portfolios?
I mean, what's incredible is that the market's up, the S&P 500 is up 28% since its October lows, right, Ryan?
Yeah, right.
And just connecting the economy and the stock market, right? If we just said, look, the economy is accelerated and we think there's not going to be a recession over the next 6 months, maybe even 9 months, right? And that's where, that was our view even at the beginning of the year and end of last year. And if the economy is doing well, which part of the stock market do you like? Well, you like the cyclical parts of it, right? You like mid and small caps. You like energy because you think if the economy is doing well, consumers are going to keep spending, especially on energy. They're going to need more of that. And then industrials too, right? Businesses are spending more and making more investments on things like, light trucks, heavy trucks, aircrafts. All of that is doing well. All of that those are areas that we like.
Well said. We've hit the 5-minute mark, everyone. With that, this is the latest Facts versus feelings, take 5. We'll see you next time. Take care.